Hello, hello. Hello, can you guys hear me? Let's put myself in this corner. Okay. Hello, Hasim. Welcome. Let me allow a couple more minutes to see who else will join us, and we'll be starting our session for today. Okay, I see some people are beginning to join us. Allow us a couple of more minutes to let some more people join us. I hope you guys are having a fantastic Wednesday and have made pretty good trades. The market surely has given us that volatility. Earnings have also done their job. Tesla coming out and surprising the market with 1 million new subscribers. The market was expecting that they had lost subscribers, and we saw that nice jump on the markets with that news. So let's all right. Well, I'm gonna begin. Welcome all. I'm Giovanni Betancourt. I will be giving you today's introduction to the Elliott Wave. Previously, before we do this, let me just leave you with this short disclaimer. Please be reminded that you are solely responsible for the trading decisions on your account. There is a very high degree of risk involved in trading. Any information and/or content is intended entirely for research, educational, and informational purposes only, and does not constitute investment or consultation advice or investment strategy. Okay. Alrighty. Welcome to all of you that are joining us. All right. So let's get into it. We're gonna be looking at the some of the history of the Elliott Wave theory. We'll be looking at some basic wave structure, some core rules. Then after that, those rules, we'll start looking at some Elliott Wave channels and the use of the Fibonacci ratio lines along with the Elliott Wave theory. Okay. So let's begin. The Elliott Wave theory, I hope that by the end of this webinar, you will be able to understand the basic concepts of the wave theory and how to apply it to your own trading to make serious, consistent profits. So markets don't ever move in a straight line. They flow much more like an ocean. In the 1930s, an American named Ralph Nelson Elliott discovered that the market action adheres to a pattern composed of waves, and he developed the wave principle, which states that market prices trend and reverse in recognizable, predictable patterns. And this happens because people in large groups behave in a predictable way, also known as herd mentality. The crowd psychology moves between phases of optimism and pessimism in a natural, predictable, repeatable way. Elliott states that we can see these changes in the crowd's collective move through the price of movement of the markets on any time frame. The principle is continuous, meaning that when one wave finishes, the next wave begins, and Elliotticians believe that all the market action fits into the wave structure. The basic 5-wave pattern that drives the market up or down, and this is called a motive wave. Now, within this wave, as we all see, and in reality, we adhere some of the Fibonacci rules, which is the ratio, the golden ratio, 0.16, 0.618, and the inverse. So as we think that the tool is a predictable tool, it is not. It doesn't really, it's not a tool to predict the market. There isn't really any way for us to predict the market, but it does come very close to it. Okay, it does come very close to it. So as we move through the markets, we find ourselves with a lot of uncertainty, and sometimes we don't have a decision to be made at the spot because we don't have the right information, or we don't see a predictable pattern in front of us. Sometimes we adhere ourselves to other rules, but the rules that are associated with the Elliott Wave principle are some hard and fast rules that cannot be broken. Okay, and it's important that we understand these rules, right? So let's take a look at what will be a complete market cycle. Okay, in this complete market cycle, we see that the motive wave is composed of three major waves, name of number 1, 2, 1, 3, and 5, and that within each motive wave, there's also another other waves inside of it, the smaller waves. They're fractal, and then we have corrective waves. Okay, so these patterns are repetitive in form which Elliott isolated these 5 such patterns, or motive corrective waves that recur in market price data, but not necessarily in time and amplitude. He named it, defined, and illustrated these patterns and their variation. He then described how they link together to form larger versions of themselves, how they link together to form the same patterns of the next larger size, and so on, producing a structural progression. And he called this the phenomenon the wave principle. So the wave principle is generated by man's social nature, mass psychology, which is, it is key to a naturally occurring mathematical progression expressed, again, by the Fibonacci sequence of the golden ratio and its inverse. And although it is one of the best forecasting tools in existence, the wave principle, like I said before, is not primarily a forecasting tool. It is a detailed description of how markets behave. The primary value of the wave principle is that it provides a context for market analysis. And this context provides both a basis for disciplined thinking and a perspective on the market's general position and outlook. And at times, its accuracy in identifying and even anticipating changes in direction is almost unbelievable. So the path of price is not a product of the news. Its movement reflects a repetition of forms that is independent both of presumed casual events and of periodicity. So taking a look at a motive, a 5-way pattern, we'll see that these waves are repeated in all of the markets. So we're drawing this basic 5-way pattern in front of us. The first sequence that moves the market up in 5 ways is number 1, 2, 3, 4, and 5. Okay, and this is followed by a corrective sequence that moves the market against the primary trend, and which can be then identified with the letters A, B, and C. Okay, but remember, these waves are fractal in nature, meaning that they are also part of a bigger wave. So this could be a wave of a larger degree, and this ABC correction will be wave 2. So we be able to find in the corrective waves, we'll find also a pattern of a 1, 2, 3, 4, and 5 sometimes. But the basic impulse wave, which is composed of 5 waves, meaning one impulsive, the second one corrective, third impulsive, fourth corrective, and the 5th impulsive. And that each corrective, okay, they will have also 3 smaller waves inside of them, the A, B, and C. So we could call this structure 5-3-5-3-5, meaning that there will be, there will be 5 waves, 3 correctives, 5 waves, 3 correctives, and then 5 waves again, impulse, okay? This is what we look for, impulse waves. Some of the rules that we're gonna be obviously to take a look and adhere to ourselves to those will be that wave 2 can never overlap the start of wave 1, meaning that the corrective wave cannot come back down to where wave 1 began, because then that will offset that one wave, the first wave. So then it will be a corrective wave, and the correction was so strong that it actually took out the previous low. So when we take out a previous low, we could say that we have broken support, and then the market could be actually turning or finding its way to a lower corrective position, finding lower support. When that doesn't happen, and the second wave does not enters or does not overlaps the start of the wave one, then we can say that we have finally seen the beginning of wave three. Okay. Now the second rule, okay, will be that the wave three can never be the smallest size, okay, price movement of the motive. So wave three is where all of the money can be made. That's where that's the strongest movement that we'll see. Okay, and so this is where we are going to be able to, if we call the beginning of wave one, or we are able to identify that wave two, is a corrective wave, then we can actually come in and take participation of the market by trading wave three. Okay, that's something that is very important for you to remember. The first rule, that wave two cannot overlap wave one. Second rule, that wave three, okay, cannot be the smallest of 1, 3, and 5. And the reason that you want to be able to identify yourself in this is because perhaps rather than being a wave three motive, it could probably just be a continuation of wave one of the first wave, of the first motive wave, that it had a short correction. So that's why you also want to make sure that if the wave three has already occurred and you come into the chart late, that the wave three is not the smallest one. And then we have another rule where it says that wave four, the correction of wave four, cannot enter the price territory of wave one. Okay, so the way for you to understand this will be that once wave three has finally ended, wave four, being a corrective wave, cannot enter or cannot go as low to come back into the price territory of wave one. Okay, if that happens, then the whole count, it has to be restarted. Okay, those are the three rules that you have to remember. Now, in an impulse motive wave, waves 1 and 5 are always motive, but they can either be an impulse or a diagonal, which we'll look at in a minute. So wave 3, though, is always an impulse, such wave 1, waves 3 and 5 are motive waves. Now, waves 2 and 4 are always corrective waves. Corrective waves have 3 waves within themselves, okay, within them, and the motive wave 5 as well. So we can say that the impulse wave structure is 5-3, 5-3-5. Okay, so here's a complete structure of the market cycle. All right. Now let's continue. Let's look at some channels. Here's where we are going to start looking at more precise ways for us to measure the impulses. So channel lines can be used to provide hints to where a turning point might occur or the magnitude of a movement, particularly whether an individual wave move might become extended. So let's take a look at this first wave. The channel lines can start to be applied after wave 2 is start to be complete. Okay, so you wait for the first impulse wave is completed, then second wave has begun and is completed. Here, as a guide to the potential extent of wave 3, you can try to draw a line from wave 1's origin through waves 2 end and extend it on. Then you can draw a parallel line above this baseline from first wave's end. These two lines act as a handy visual guide or channel, illustrating the likely boundaries for normal wave 3 as it develops. So lastly, you want to draw a line from the end of wave 2 that parallels the line forming wave 1. You want to mark the point on the top parallel line where this potential wave 3 end will intersect the top guideline. So also mark the point of intersection if wave 3's amplitude was equal to 100% of wave 1. So depending on the character of waves 1 and 2, these two intercept points may well not be in the same place. Again, this is only a guide, but it suggests a range for wave 3 and can be used as a complement to the Fibonacci sections that follow. So if you like, you can go ahead and take a screenshot of this so that you can have it as a reference. Now let's take another look, another wave. So then we say that on seeing the turn into wave 4, right? We seen wave 3 develop. Now we have found resistance. Here comes the corrective wave of wave 4, and we want to have let's say for example, we want to have a projection of how far wave 4 can correct. Again, if you are an aggressive trader, here is a way to go counter trend. Short the market, come in and sell that movement if you are an aggressive trader. So on seeing the turn into wave 4, we want to be able to draw a line from the end of wave 1 through wave 3 end. Then next draw and extend a parallel line to this from the end of wave 2. And then finally add a horizontal line from the top of wave 1 across 2 and breaking the bottom channel line. So wave 4, as it unfolds, cannot break this horizontal line extended from the top of wave 1, and the bottom parallel line provides a guide to its potential extent. So now we have a potential extent of wave 4. Again, go ahead and take a screenshot so you can save this image for reference. Let's go into another one. So we are here. Once we have seen the wave 4's end, we draw a channel by drawing a baseline joining the end of 2 and 4, okay? And we draw a line, a line parallel to this starting from the end of 3. As wave 5 develops, it may well remain inside the drawn lines. But however, if it breaks the top channel line, then it's likely to go on and be extended. And this is especially true if 1 and 3 are equal or very similar in size in price movement. Alternatively, if wave 3 extends, then you can start the parallel guide from end of wave 1. Okay, so here you have the way of probable extensions just by drawing a channel lines. To these channel lines, to the extensions, you can use the Fibonacci extension tool so you can have the targeted values. It's a very good tool to use. Okay. Now let's take a look at what the ways we'll be looking at if we have the Fibonacci to apply. There are some relationships, aspects of the waves that often do reflect these Fibonacci ratios, and then more importantly, the golden ratio known as 5, or which is 0.618. We'll see this over and over again in technical analysis. We'll look at the Fibonacci's now and of this use. The most common will be the 50% and the golden ratio, and the occasion of the extension will be the 70% or the 100%. This is where you could probably extend, or the retracement of the wave 1 could probably be. Okay, using along with what we had of the channel lines, this particularly can be very useful for us. That way we won't be trading blindly, if you will. Okay, so let's take a look at another. So this right here, okay, we can take a look at the amplitude of wave 3, okay, based on the degree of wave 2 retracement and size of the wave 1. So as we normally expect wave 2 to turn into wave 3 after retracing 50% or 61.8% of its one of the first wave price movement, if turning at 50%, we can expect that wave 3 will travel 100% of wave 1. So if the turning into wave 3 is at 61.8%, expect a move of at least 100% of our wave 1. But now, if wave 2 retraces all of wave 1, but not further, expect wave 3 to move up to 161.8% of wave 1 vertical move. This is considered the limit of a normal wave 1 move, but it can on occasion extend up to 461% of wave 1's movement. So between 100 and 461, there are a number of possible target percentages that are more or less likely to occur. Now, this obviously can happen when we have a running market. That's obviously a case to consider, okay? Let's take a look at, you can also go ahead and take a screenshot of this if you like. So here we come, as we want to be able to measure the extension or measure the retracement of wave 4. So if of wave 4, it retraces to the first level of the Fibonacci of 23.8%, we can continue, we can expect that movement, and then the beginning of wave 5 can begin, and so forth and so on with the other numbers. So how often will this happen? 38 at the 38.2% is where it will often happen for wave 4 to come to. Okay, wave 4, its correction can be measured to up to 38.2%. So if wave 3 is the normal range, up to 161% of the wave 1's magnitude, let's say for example, then the corrective wave would be expected to retrace 38.2% of wave 1 movement, or as far as 50%. Those are just some basic rules. Here, using the Fibonacci ratio lines, we can expect movements, or we can measure those movements of the waves using the Fibonacci. And it's very simple. We can obviously be able to find a chart that has already made all of the 5 waves and is in the correct stage, so that we can come in and just measure them, each one of them. The time frame doesn't, if you can find this in any time frame, okay, that you'll be able to use. So there is a wave, or there's a calling of what's called a truncation. Now, there are a type of impulse wave called truncation. Now, this is when wave 5 fails to terminate beyond the end of wave 3. It fails to advance price, and is a sign of exhaustion of the main trend. Now, that often makes sense when wave 3 was really strong and giving signs of a total trend exhaustion. We can send you a copy. Okay, we can send you a copy, Rafael. So the connection is breaking up. Is that what happening? Yep. Okay. All right, so what I was saying, so basically, yep, okay, okay. So let's talk about the truncation real quick. Now, like I was telling, it often makes sense when wave 3 was really strong, and given the signs of total trend exhaustion, the following reversal is often sharp and fast. Wave 3 was strong, so the market's tired. There's exhaustion signals here, and then wave 5 following correction is often very, very strong. So we'll see wave 1 movement, the second wave in corrective, wave 3 it has made its movement, then wave 4 has corrected, but wave 5 has not been able to take out or move beyond the high of wave 3. So when you identify this, the scenario, this can be a signal, like it says, of exhaustion, and you can come in and short the market. So if it's comforting that all of the market's price action can fit into a defined wave structure, now behind that structure, they're thinking about, does this make sense in terms of what we know about market action? So why does wave 3 seem so powerful? See, wave 3 is where you're going to be able to make all the biggest amount of money. The market does seem to move in waves, and the characteristics of certain waves are logical based on what we know of psychology of traders, investors, and the overall market participants. So look at the charts, find these patterns, and try to use Elliott Wave analysis to stack the odds in your favor, okay? So we'll go again over more of the truncation. This could be an example of how you could have entered the market in your first movement, the first wave, okay? We have a corrected sense, impulse wave, wave 3, and then we have the truncation scenario where we come in and look to short the market. Okay, the same way works after a downtrend. So the first truncation comes from an uptrend, and then the second, it would obviously come from a downtrend. So let me stop here. I'm gonna go into charts so we can take a look at more examples. Okay. All right. So in front of us, we have the 2-hour on the NASDAQ futures. Okay. In this chart, okay, we can actually see the truncation example kind of develop in front of us. If we take a look at how we can count this, it could be that this is wave 1, okay? This is wave 2 corrective, wave 3, okay? Then wave 4, and this is wave 5. All of this is wave 5. It didn't really make it any bigger movements, and then market started to move up to the upside. Here in this movement, we can say that let's see, take out this movement, where we can see that the wave 1 will be all of this, and inside of wave 1, we could see that we have also done a smaller movement of wave 1, wave 2, wave 3, wave 4, and wave 5. Okay, so this wave 5 is a first set of movements. Then we have the corrective, wave 1, 2, and 3. Okay, that's 3. Then we have wave 4, wave, again, wave 1, wave 2. But here in this wave, we actually find more of a corrective size. Okay, so here the count had to be redone, restarted. Right, we have a gap that usually market comes to almost close it. And when we have these gaps, okay, we have a resistance real close by. So now market has entered into a consolidation stage. And from this stage, from when the market breaks out of this, either to the upside or to the downside, is where we're going to begin redoing our wave counting. Okay, so as we begin our wave counting, after this movement, we'll be able to take participation of the wave theory. We can use our Fibonacci tools, retracement tools, to use in our favor. Let's let me change the time frame, 30 minutes, but still in this market, it has not been that much of a movement. Let me take a look another one at this. Okay, this is the S&P. It will be about the same scenario. Okay, yes, Royland. So we have right now, we don't have that much of a price movement in the indices at this for the last 2 hours. It has been just really those 2 big candles. If we look at 30 minutes, right now we would be in a corrective wave, but right now the market is just really in a channel. It's a very, very tight channel. So I don't think we'll be able to find much use of it. Let's see if we can use the crude oil. Go to 30 minutes. Yeah. Also the same. There's not much movement right now in the market for us to come and find or begin using the wave theory, the count. Okay. Let's see, natural gas has made a parabolic movement to the upside. Okay, let's say, for example, that we have began, all right, we have began our count. So we have wave 1, and this would be wave 2, and right now, okay, we'll be beginning wave 3. So in this essence, we want to be able to use our Fibonacci extension tool. We'll come down, use this point, use that point, and then we'll come in and use this point. Let me just so we have this movement, and this using this extension tool, we can begin to see how we can extend. All right, we can use the tool to see where the market can extend to. We say that most often, right, we'll be able to move to the 50%. Okay, now the retracement is another story. So we will have to use to find out the extent, the retracement of the movement, like this, and then we say that 38% is the normal, but right now we could say that it's looking to do a bit higher than that. Let me erase all of these things. All right, I saw a question. All right. Let me, yeah, okay. So the market right now could be looking to retrace. Right now in the 23%. If it begins to continue to move here, this would be the beginning for us to begin using the channel. Okay. Now, obviously, in this chart, all right. If we do this right here, okay, we could probably project that the movement of natural gas already has made a $8 movement. For it to continue, obviously we will need more negative news. But the market right now is looking for a correction. Now for the movement to continue, all right, we'll have to wait to see if it retraces back into the 50%, which is the most often, and then we'll find that movement to the upside. Let me see. I'll have questions. Okay, so that is that. Okay, let's take a look at another contract. I see somebody raising their hand. Okay. Let me see. Go ahead, Royland. You muted. If you wanna ask something, you can ask me.
I forget what I got to ask you.
Yeah. Okay, now I can hear you. Go ahead.
No, them thing we show with the Elliott Wave, it would be better if we get to do it on the chart. But right now the market isn't really looking too nice for the on the chart.
Which chart do you want to see?
Oh, you're applying the Elliott Wave on the chart. Can you try, but they didn't get into just now.
I'm sorry, but I can't understand which chart you want from me to see. You want to see
the Elliott Wave we're talking about.
That the one that would right here. This is gold. You want to talk about gold?
Yeah, we could talk about gold.
Okay. All right. So let's take a look at gold. Okay. So gold, we have in 2 hours. All right. So we have broken support of 1700. In this essence of gold, using the Elliott Wave theory, we have to wait, obviously, for us to see that gold has made new lows. It's making them new lows, obviously, right now, but we will have to wait for the market to enter a corrective wave. Right now, we are in the first impulse wave. Okay, so at this moment, we'll have to wait to see where this particular candle will finish. Looking at support for gold, we will want to be able to use psychological numbers, round numbers. 1,690, for example, will be our next support level. Before that, you can go by round numbers, 98, 96, 94, 92. Okay, so the closest one would be 98. You can either be aggressive, enter the market on this impulse, but to be more realistic, you want to wait to see if it will come down to 60 to 98, and here will enter a corrective wave, so you can actually call this movement up to that moment wave 1, and then the corrective wave will be wave 2, and see where that wave will end up. So if we use the beginning of this wave, either from here or from here, which will be the best way to actually analyze it, then you are looking at this candle for it to finish and show you the support. Now, that movement that we just saw, that was probably an order that was sitting there to sell, okay? And so we probably will come down to 98 and find that support. Okay, so right now in this candle in 30 minutes, that's what, let's take a look at 5. And in 5 minutes, we are still in that wave 1. Okay, we are wave 1. The sentiment for gold to continue to move lower will really help determined by the movement of the dollar index. If the dollar index makes another jump towards the 107,300 level, then in gold, we'll see that continuation of the movement lower, breaking 198. Okay, so how much lower can this go? Obviously, there's a lot of room for it to continue to drop. But one way for us to obviously come in and find out will be to look at previous levels, history, but we have to go back and see that the lowest point so far of this month of July 14th was almost 1,698. Okay. If we contract the chart, we'll see that we haven't been this low in a long time. So this will be a moment for you to pay attention to. For gold market is about to have to break this lowest point, and then that will be the support that you're gonna want to take a look at and be ready to trade to the downside if it continues. Okay, will it find support at this level, or will it continue to go lower? Again, we are in a very good moment. You pay attention to it. 198. It was 97. The value of that lower point. So around that level, we want to be able to come see and find entries to the downside. Okay, to the downside. Because right now we are entering, we're creating the first wave. So this will be a great example for you to at least follow through with the channel lines and follow through with the Fibonacci extensions, so that you can project yourself how much lower can this go. 198 and 1698 is where the support really is at. Okay, 1697.25 is another value, but brown psychological numbers 1698. All right, so this one most likely will continue to drop. Take a look at the dollar index. Let's take a look at the same time frame as we were. So in the last 2 hours, it's been on the downside, but let's see what it has been doing the last 5 minutes. Not much. Be flat. Wow, it's been flat. So this movement of gold, it most likely will continue to go lower. Let's take a look at Bitcoin in the 2-hour channel. So taking the account, okay, of the Elliott Wave, because probably say that this was wave 1, this was wave 2, and this is wave 3. But as we have a rule that wave 3 cannot be the shortest of 1, 3, and 5. Okay, so we can say that this corrective wave right here, 2, actually 4, could not be counted because we have the wave 3 cannot be shorter than wave 1. So this count cannot be applied. Okay, we will have to wait, obviously, to see if all of this is actually wave 1. Okay, remember wave 1, wave 2. Okay, this is wave 2, and then wave 3, and then wave 4, wave 5. But that will be for us to determine in a better time frame. Let's take a look at 30 minutes. In 30 minutes, okay, we can take another account as being wave 1, okay, wave 2, and all of this is wave 3. Okay, wave 4, and this could probably enter in this time frame. This could probably enter into a truncation. All right, so we have wave 1, wave 2, wave 3, wave 4, and then this is supposed to be wave 5. All right, so a truncation can happen now, and the truncation determines or shows that expansion has occurred and that the market could continue to move lower. Okay, in 30 minutes. If you change the time frame to 5 minutes, you will see that that is the case. All right, so we have the pivot 23,490 very close as support. Market seems to have found some support around the 23,600 level, and so you could probably move higher. And this is the Euro USD in 2 hours. Let's take a look at 30 minutes. All right, so nothing happened with the counts right now for us to come and say that this could be wave 1 to the downside, but we have to wait and see, because this will be the count. This can be wave 1, okay? This is the corrective wave 2, and will be beginning of wave 3, okay? So we have to analyze how much of is this movement, and this movement should be longer for wave 3. So we at least will have a knowledge, okay, so if we move 700 pips, then we'll know that we're looking for 700 movement to the downside. If that's the case, that it goes to move to the downside, the Euro. For it to happen, obviously we need to see that the dollar index shoots up or goes above 107 for it to happen. Okay. All right. So gold, we are looking at probably we're nearing the that mark of support, important level of support. Will we break it? If it's broken, most likely this will drop. You can add an RSI to see how oversold it is. You can find using a MACD to see where it's at. And to use extensions right now to see how much lower it will go, we want to be able to have a third point so we can calculate that the next candle. But in 35 minutes, we're seeing that we're still in wave one. You can count all of this as wave one. And the way you count that will be for you to say, okay, so this is wave one, wave two, wave three, wave four, we could be in wave five, or you can just say this is all wave one. All right, so we have to wait to see where wave two will come, and then at that moment we want to be able to short the market at around that level, when that happens actually. Okay. All right. Well, guys, that's it. That's all for right now. I hope you find this useful in the near future. Make use of the channel lines, of the Fibonacci extension lines, and see how much you can increment in your trades, how many positive trades you can have. Okay. All righty. Well, that's it for me so far. The gold market is looking to continue to drop. 196 will be my next level. Okay. Then 190. Could it be 190 where it finds bottom? Or would it find bottom on 196? Or would it find bottom where it's at now? And then from here, rally back up. The consensus could probably be it will continue to drop. So stay tuned. Keep an eye on gold because it sure is moving. Okay. Now that's it for me. Thank you for assisting, and I will be sending you guys a copy. Okay, as you requested, Royland. Okay. Right. So thank you for watching. Until next time. Bye for now.